Hi everyone, welcome to Tax Vichara. In this channel, we bring you knowledge, updates, and practical tips on tax. Today, we are starting a new series. At the end of this course, you will get a basic conceptual understanding of international tax. This series is for you if you are a student or a professional in accountancy, commerce, or law and interested in learning international taxation. My name is Vaishaka Bhat. I'm a practicing CA with specific focus on international tax and transfer pricing. I'm joined today by my colleague, CA Sumana Rao, who also has a vast experience in international tax.
Hi everyone, welcome to the series on international taxation.
Okay, let's get started. What comes to our mind when we talk about international tax is a Double Taxation Avoidance Agreement or DTAA. In this module, we will have an introductory understanding of the taxes imposed on cross border transactions, types of double taxation, reasons for double taxation, and how the double taxation avoidance agreements help in avoiding such a double taxation. Normally, countries have sovereign right to impose tax on income which arises in its jurisdiction, a property situated in its jurisdiction, and upon happening of certain events such as manufacture, sale, consumption, etc. An issue arises in the context of international trading of goods or services or property as to which country has the right to tax the income or the event. Now let's understand this with an example. Take a large company like Amazon, which is based in the US, carrying on its business across the globe. Assume Amazon sells a computer gadget directly to you who is sitting in India. You pay $1,600 for the gadget to Amazon directly through net banking or online portal. Amazon purchased this product at $1,200 and further incurred a selling cost of $100. It therefore makes a profit of $300 on this deal. We assume here that the sale is concluded in India. Since Amazon is a US company, the US IRS will want to tax the profits of the $300, let's say at 21%, which amounts to $63. However, since the sale is concluded in India, the Indian government may also want to tax the business profits at the applicable rate of 40% for foreign companies, which amounts to $120. The total tax comes to $183, which is about 61% of the total profits earned by Amazon. Can businesses function if tax was imposed this way? The cross border trade and business would never happen if the taxation system worked in this way. In this series, we will see how the double taxation avoidance agreements help in such circumstances. Before we proceed, let's understand a little bit more about why both US and India wants to tax the same transaction in the example we just saw. Sumana, can you please explain this for us?
Firstly, US seeks to tax the income as it is earned by Amazon, a company which is incorporated in the US. This is residency-based taxation system. India also seeks to tax the same income of Amazon on the premise that the sale was concluded in India, thereby giving rise to a source in India. This is source-based taxation. As can be seen, tax is imposed on a taxpayer on his income, property, event, etc. if such person, income, property, or the event has a nexus with the jurisdiction. Such nexus can either be a residential status of the taxpayer or the place of source of income. Countries have freedom to decide on the nature of nexus basis which charge on income arises. Where a country imposes residency-based taxation, a person who is a resident is taxed on his global income in that jurisdiction, irrespective of the place of source of income. This is also known as principle of taxation on worldwide income. Residency of individuals can be determined basis their domicile or citizenship or any other criteria, and Residency of other entities can be determined basis their place of incorporation, registration, establishment, or place where effective control and management of the entity is situated. India adopts residency-based taxation while taxing its residents. Some countries may adopt source-based taxation, wherein only incomes sourced in that country will be taxed regardless of the residence of the taxpayer. This is also known as principle of territoriality. Here, residents may not be taxed on their foreign sourced income, and irrespective of residential status, only income sourced in that country is sought to be taxed. India adopts this method of taxation while taxing its non-residents.
As we saw in the example, Amazon, being a non resident in India, is subject to tax in India since its source of income is in India. It is also taxed in the US as it is a resident there. There is a double levy of tax on the same income, that is, a $300 of profits, on the same person in different countries. Thus, there is a double taxation in the system. This example explains a case of juridical double taxation arising due to conflict in the residence source rules. However, there could also be a conflict due to residence rule. Let's take the example of another large multinational in India, say Infosys. Let's assume Infosys has incorporated a subsidiary in Singapore to hold some of its overseas investments and it earns certain related income. Let's take for an example $10,000. However, given that the whole leadership team is in India, most of the board meetings of Infosys Singapore happens in India. Now, Singapore government would tax Infosys Singapore on its income of $10,000 at the corporate tax rate of say 17% on the basis that it is a resident of Singapore by way of incorporation. However, Indian government may allege that the place of effective management of Infosys Singapore is in India and accordingly seek to tax the same income of $10,000 in India at the applicable corporate tax rate to a foreign company being 40% on the basis that it becomes a resident of India. So here we have a situation where the same $10,000 is taxed both in India and Singapore on the basis of the residential status, bringing the effective tax rate to 57%. In other words, to earn an income from investment of $10,000, the group has incurred a tax cost of $5,700. This shall obviously make the investments unviable. Now, both the above cases where there is a double taxation for the same person or a taxpayer in two jurisdictions, and therefore it's called the juridical double taxation. Another category of double taxation, called the economic double taxation, arises when same income is included in the tax base of different taxpayers. The most common causes of economic double taxation are the taxing of profits for transaction between associated enterprises in a transfer pricing situation. If you want to understand the basics of transfer pricing, please check out our playlist on our series called What is Transfer Pricing. We explain the basics of India TP provisions in a simple manner. So this is a slight tweak to the example 1. Under this example, Amazon US has set up a wholly owned subsidiary, Amazon India, which provides certain support services in the form of providing information relating to its target market in India, and Amazon US pays a consideration of $100 to Amazon India. Since Amazon US has paid $100 to Amazon India, its profit now is $200 instead of the earlier $300. Unlike the earlier example, we assume here that the income of Amazon US is not taxed in India on account of any source rule. So, Amazon US shall offer to tax only in the US its profits of $200 and pay a corporate tax of $42 at the rate of 21%. Further, Amazon India offers $100 to tax in India. However, during a scrutiny proceedings, the transfer pricing officer in India alleges that the transfer price is not at arm's length and hence makes an upward income adjustment to the transfer price in the hands of Amazon India by increasing the consideration to $150. Accordingly, Amazon India has to pay higher taxes on the additional $50. However, the additional $50 is not claimed as expense in the hands of Amazon US. This triggers economic double taxation as the same income, that is $50, have been subject to taxation in the hands of both Amazon US and Amazon India. To recap, example 1 and 2 gives rise to juridical double taxation and example 3 gives rise to economic double taxation. Please know that these examples are fictional, set out here purely to understand the concept better, and especially in a situation where the DTAAs did not exist. So, Sumana, how does the DTAA help eliminate the effect of double taxation?
Double taxation avoidance agreements or DTAAs or tax treaties shall relieve double taxation by allocating tax rights between the countries or by eliminating double taxation either through credit method or exemption method or by establishing criteria for determining an exclusive residential status for taxpayers or by providing access to competent authority negotiation and consequently allowing corresponding adjustment. Let us understand each of the above with the help of our examples. In our first example, since the income of Amazon qualifies to be business income, the India-US DTAA provides that such income shall be taxable in India only if Amazon has a permanent establishment or a PE in India and income from transaction of sale is attributable to such PE. In the absence of such PE, the income will be taxable only in the US. So, owing to presence of DTAA, 300 may not be taxable in India at 40% if Amazon does not have a PE. This is a way of eliminating double taxation by allocating the taxation rights. That is, the source state, India in our example, can tax USD 300 only if Amazon has a PE in India. We will discuss and understand the concept of PE in detail in upcoming modules.
That's right. Likewise, in our example 3, where Infosys Singapore is taxed in both India and Singapore, the DTA would seek to eliminate double taxation by way of resolving the dual residency. As per Article 4.3 of the India Singapore DTA, the dual residency for the company is sought to be resolved by deeming that it becomes a resident of the country in which it has its place of effective management. Since Infosys Singapore has its place of effective management in India, India will be considered as a resident state. By this, the situation of both countries taxing the same income is avoided. But what happens in the earlier example if Amazon has a PE in India? The income attributable to such PE shall be taxed in India, in addition to it anyway being taxed in the US owing to its residency. In such cases, the DTA will provide a mechanism to eliminate double taxation through a system of foreign tax credit. We will discuss the same shortly in the next slide. Lastly, under example 3, relief can be obtained through mutual agreement procedure and enabling corresponding adjustment. We will also understand this in detail through an example. Now, to understand the foreign tax credit system better, Sumana, can you please explain the different ways in which double taxation is eliminated by the double taxation avoidance agreement?
There are broadly two types of elimination of double taxation, that is credit method and exemption method. If a tax treaty eliminates double taxation by credit method, say in our first example, US will calculate tax on Indian sourced income and allow a tax credit to the extent of tax paid in India on the same income. In the example, India sourced income is USD 300, which shall be included in the total income of Amazon in US. US will compute tax at 21% on this income, which amounts to USD 63. However, since Amazon has a PE in India, India as a source country can levy tax at 40%, which amounts to USD 120. Since the Tax treaty allocates the rights of taxation to India, that is the source state. USA will allow a credit of taxes paid in India. However, such credit is restricted to the extent of US taxes, which is nothing but USD 63. The balance credit of 57 shall be sunk cost unless such credit can be carried forward or can be pooled against other income. This depends on the respective domestic laws of each country. Where a treaty eliminates double taxation by exemption method, then USA will not at all include the Indian sourced income while computing the total income of Amazon. Thus, only India will tax such income. The effect under both methods is that there is only one levy of tax at the higher of applicable tax rates, which will be paid by Amazon rather than paying taxes on the same income twice and in two jurisdictions. Vaishaka, can you explain how the tax treaty provides relief in case of economic double taxation?
Sure. In the example 3, double taxation can be eliminated by virtue of Article 9.2 of India-US Treaty to ensure consistent allocation of profits. As per Article 9.2, where India taxes Amazon India for the additional $50 pursuant to the upward TB adjustment on which Amazon has been charged to tax in the US, and if such adjustment is not disputed, then the US shall make an appropriate corresponding adjustment to the profits of Amazon US by allowing as an additional expense deduction unilaterally. The effect of this will result in $50 not being taxed in the hands of Amazon US, thereby eliminating the double taxation. Amazon US shall pay tax at 21% only on the $150 as against the initial profits of $200. However, if there is a dispute on the extent of upward adjustment made by the Indian transfer pricing officer, Amazon US and Amazon India could invoke the Mutual Agreement Procedure or MAP, wherein the competent authorities of the two countries would enter into a discussion to decide the right amount and accordingly provide corresponding adjustment such that Amazon does not suffer any kind of a double taxation. So that brings us to the end of this module. As we saw here, the DTAA is a powerful tool that helps eliminate double taxation that may arise in cross border trade. In the next module, we will understand how the DTAs are structured and standardized and how one can interpret the DTAA. We will also see some introductory concepts in the application of the DTAA. Thank you so much for watching. We will see you in the next module.